After almost a decade of uninterrupted growth, housing prices in the EU have taken an unexpected turn. As 2022 came to a close, a quarterly fall in housing prices emerged, the first since 2015. Citing data from Eurostat, the final quarter of 2022 saw a 1.5% dip in house prices, with significant reductions in 15 of the 27 EU member countries. Meanwhile, the sturdy members of the EU economy, Denmark and Germany, were hit the hardest, with drops of 6.5% and 5% respectively. So with rapidly increasing mortgage rates in the EU and inflation out of control, we may witness the biggest housing market crash in modern history. And today on Profit Protection, we'll explore what's caused the housing market to fall and how this may affect your economy. Now, make sure to stick around until the end, as I'll explain why the outlook may not be as grim as it seems to be. While the dropping prices might seem like a sudden change, the underlying factors have been brewing for a while. The cost of living in the EU has been on an upward trend, and interest rates have been gradually increasing. This cocktail of economic pressures has made home ownership a difficult thing to achieve for a lot of Europeans, leading to a slump in demand for mortgages. The result? It's a downward pressure on property prices. This isn't just a blip on the radar, though. Early signs in 2023 suggest that the trend is set to continue. Dutch house prices, for instance, took a 1.5% hit between January and February. However, the situation isn't universally grim. Croatia, for example, enjoyed a 4.7% hike in house prices in the final quarter of 2022, driven primarily by rising demand from foreign buyers. Now, let's put that into perspective. Despite the recent downturn, house prices are still over 50% higher than what they were in early 2014. That's a considerable increase, and it's only natural that what goes up must come down. So is this a crisis or is it a correction? Well, to answer that, we need to look at the role of the European Central Bank and other rate setters. They've been gradually raising interest rates, and this is expected to continue. Higher interest rates means higher borrowing costs, and this is undoubtedly going to impact the housing market. However, this isn't necessarily a bad thing. Anya Hyman, an economist at S&P Global Market Intelligence, argues that this downward trend in house price growth could be beneficial in the long run. With the lack of investment from the construction sector limiting supply, the market could eventually stabilize. In other words, this could be the correction the market needs to ensure long-term stability and sustainability. But what about the banks? The ECB recently upped its deposit rate to 3%, a level not seen since the 2008 financial crisis. There are even whispers of another increase in May. This has led banks to tighten credit conditions, a response likely to be made worse by recent industry shakeups, including the Silicon Valley Bank collapse in the US and the forced sale of Credit Suisse by UBS. On the surface, this might seem like a negative development, but consider the words of Luis de Guindos, vice president of the ECB. He suggests that an increase in banks' funding costs, stricter credit standards, and a slowdown in lending volume growth could be on the horizon. This might sound alarming, but let's remember that reckless lending and loose credit standards were major contributors to the 2008 financial crisis. So, a tightening of credit standards and a slowdown in lending could actually make the financial system more robust and resilient. A closer look at the lending landscape reveals that banks' total lending to Eurozone customers fell for 3 consecutive months up until February. This puts an end to a nearly 5-year period of growth, with a total decline amounting to 72 billion euros. While this may seem worrisome at first glance, it's important to remember that unchecked lending growth can lead to unsustainable debt levels, potentially triggering a financial crisis. A more measured pace of lending, as we're seeing now, can contribute to greater financial stability. It's also worth noting that the UK has also seen a significant downturn in its housing market, as there's been a year-on-year drop of 3.1%, the largest since 2009. This development further illustrates that the cooling trend in the housing market is not isolated to the Eurozone. But let's circle back to our original question. Is this downturn a crisis or a correction? The signs point to the latter. While the current situation might cause some discomfort in the short term, it appears to be a much-needed recalibration rather than an impending disaster. Anyways, the cool down in the EU housing market should be viewed as a necessary adjustment after a decade-long boom rather than an economic nightmare. This period of adjustment is likely to pave the way for a more balanced and sustainable housing market. The rising cost of living and higher interest rates, while currently acting as deterrents, are crucial checks and balances preventing the formation of a housing bubble. It may be uncomfortable, but it's a necessary discomfort, one that signals the beginning of a healthier, more balanced housing market in the EU. However, if you want to learn learn more about a housing market that is extremely unhealthy, you might want to check out our video on China's Ponzi-like property market that is eroding faith in the CCP. This might help put what we've talked about today into perspective, so if you like what you see, don't forget to hit that like button and subscribe to the channel for more updates on finance, investing, and geopolitics. But until then, I'll be seeing you.